K-Boost is a Colombian company that produces natural energy drinks. Our drinks are made of tropical fruits and also plant extracts. The purpose of K-Boost is to give people energy in a safe and in a natural way, showing that it is possible to enjoy an energy drink without harming our health. If we talk about this food matrix, we have that K-Boost has many strengths, such as being natural, sustainable, it is also customizable. Um, K-Boost avoids the negative side effects of the caffeine and offers a unique tropical flavors. Also, its weaknesses are that it is a new product with little visibility and that natural ingredients are more expensive. K-Boost has as opportunities this healthy wave, also the eco-friendly trends, and all the partnerships it can create with the universities. The main threats are the large energy drink brands that has a strong marketing. Also, these doubts about obtaining energy from a drink without caffeine, and also these changes in the food regulation. K-Boost solves the problem of traditional energy drinks that are full of sugar and the synthetic caffeine. Instead, offers a natural and healthier alternative. The main customers are university students, young professionals, and health conscious people, as well as some cafeterias and some events. The unique value proposition is to be natural, sustainable, and to bring a personalized energy. Um, this solution includes the use of natural ingredients mixed with a natural hydration from the tropical fruit flavors. K-Boost will reach the customers through campus sales, some supermarkets, and using online subscriptions. The revenue model is based on the retail sales, the subscriptions, and partnerships, while the main cost come from the ingredients, packaging, production, and distribution. The key metrics include the sales growth, repeat purchases, and the subscription retention. The K-Boost unfair advantage is the personalization options, the eco-friendly packaging, and the expert design uh, flavors, which are difficult from competitors to copy quickly.
Okay, and the best-sell analysis of K-Bus highlights the main external factors there. Check the business environment, politic and drinking regulations may impose restriction or may pay and advertisements. Where sustainable ventures can benefit from government's incentives and the economy. The healthy product market is expanded also to material price of frozen zones. But pressures on production and distribution costs. Socially, yogurt consumer are increasingly um, demanding in natural and eco-friendly alternatives to support our brand positioning. Technology, digital product force and advances by the biodegradable packaging provide opportunity for different solutions. Environmental sustainability is bold and stretch and challenge these climate conditions may affect the supply of natural ingredients. Finally, from a legal standpoint, food safety and heavily regulation requiring strict compliance, ensuring consumer trust and transparency. Okay, and the best marketing shows how K-Box difference itself from K competitors Zeus and Red Bull, for example, Monster and Eltor Vivacien, while established brands rely on massive advertising budgets and a strong distribution network. And K-Word focus of natural ingredients, biodegradable package and affordable price. Its main competitive advantages is offering high energy without the side effect of caffeine and combined with innovation and consumer flavors. However, one of the main changes is building brand awareness and optimizing the marketing budget by targeting university students and leveraging digital channels. K-Bosch has the potential to position is a sustainable and healthy alternative to traditional energy drinks.
In 2023, Colombia's GDP was about 1.57 trillion pesos. The food and the beverage industry represent the 3% of this GDP, which is about 47 trillion pesos. Inside this industry, beverage account for 40% eh, of the GDP, equal to 18.8 trillion pesos. From that, the natural beverage take between 15 to 25%, which means a market of around 2.8 to 4.7 trillion pesos. Globally, the healthy and natural beverage categories are growing faster than the conventional ones, with an annual growth rate between 3.5% and 7%, and even higher in the premium or the emerging markets. Specifically in Colombia, the natural and healthy beverage is following this trend. Conventional energy drinks have grown sharply in the recent years, and the natural energy drinks are riding the same wave.
Okay, profitability in terms the food and beverage sector in Colombia. Reports average EBITDA margins range between 12 and 18%, although natural beverages are profitable in the long run. They face high initial costs due to innovation and sustainable production methods is compared to large competition. K-Ball's challenge is to achieve economies of scale in both productions, volume and distribution in order to reduce operation costs relative to inventories difference. and the Spain's be unsustainably drives vector. Cape was most currently Manses expenses are efficiencies to maintain competitive margins in the market.
Now, let's examine our company's financial structure through a vertical analysis. This means we're expressing everything on our balance sheet as a percentage of our total assets. It is like taking an X-ray of our financial health, so showing the relative weight of each component, focusing on our assets, cash with a 38.38% and accounts receivable for 23.24% together represent over 60% of our assets. This indicates strong liquidity. We have ex- ample available funds and money due from customers, providing a solid operation cushion. In the fixed assets, with a 25.51% investment in the essential equipment and infrastructure that power our operations. On the liabilities and equity side, the key takeaway is our deep free status loan 0%. Our main obligations are to suppliers, accounts payable at 14%, which is standard and manageable. Critically, over 80% of our funding comes from owners' capital. This demonstrates a conservative, stable financial structure built on commitment rather than debt, significantly reducing risk. In summary, this analysis reveals a highly liquid, stable company with a strong equity base and no dips. This financial foundation is low risk and perfectly positioned for strategic growth.
Now let's analyze the contribution margin. So the contribution margin is calculated as a sales minus variable costs. In our case, sales were 192.31, while variable costs were uh, 47.50, giving you a contribution margin of 144.81. When expressed as a percentage, contribution margin equals contribution margin divided by sales multiplied by 100. And the result is approximately 75.3 percentage. This is a strong indicator of financial health. A 75.2% contribution margin means that for every unit sold, more than three quarters of the revenue goes toward covering fixed costs and generating profit. For KBOS, this demonstrates a highly efficient cost structure, providing a solid foundation for profitability and sustainability.
These slides moves from structure to performance, showcasing our key profitability indicators and break-even point. Let's look the two most critical metrics for investors. The first one, the return on assets, with a 3.16% after taxes. This tells us that for every 100 pesos invested in company assets, we generate 3.16 pesos in profits. It is a measure of how efficiently we use what we have. And the second one, the return on equity with a 4.90% after tax. This is bottom line from you, the investors. It means from every 100 pesos on capital invest, the company returns 4.90 pesos in profit to its owners. Now let's look at the break-even graphic, the point where the revenue line crosses the total cost line is our break-even point. This is the minimum sales volume, we need to cover all costs and start generating profit. The significant gap between our current performance and this point confirms that our business model is not just viable, but already profitable and operating with a safe margin. In conclusion, these indicators provide we are not just structurally sound, but also effective at covering our assets and your capital into solid returns with a clear stable border. We are ready to scale, and your investment will be the capitalist from that word.
So as we can see, profitability increases steadily as the price rise. A lower price point such as 1.40 profitability is negative, around less than 7%. However, once the price move to 1.50, profitability becomes positive, reaching 1.1%. These overall trends continue, achieving 12.3% profitability at that price is 1.80. This shows how sensitive profitability is to pricing decisions and highlights the importance of setting an optimal price point. So, also in our sample, sales were 192.31. The variable costs were 47.50, and therefore the contribution margin is 144.81. This means that for every peso or unity of currency, in this case USD sold, um, 75 cents remain available to cover fixed cost and generate profit. So also net income, um, looking at net income, we observe a similar relationship with price at 1.40. Net income is negative, around less than 11.06 as the price increased to 1.30. Net income turns positive at 2.25 and continues to grow, reaching 26.65 at the price of 1.80. This indicates that even a small change in price can have significant impact of the bottom line.